Good morning, everyone. Welcome. It's right around 9:30, so we'll be getting started in just a few minutes. We'll give everyone a chance to get logged in. Hi, everyone that's just logged in. We're gonna wait just one more minute to see if we can get a few more of our folks in here. All right, let's get started. As you're listening to the presentation today, just one housekeeping note. If you do have questions for us during the presentation, there is a Q&A function down at the bottom of your screen. And so you won't be able to talk to us for your questions, but if you enter and type in the questions, we have some time at the end available for us to answer those questions for you. So today we'll be having a conversation about COVID-19's impact on the economy and the markets. I'm Aliya Riddle, an associate investment advisor, and I've been at Bartlett for 2 years. And here with me today is Jim Hagerty, who has been a wealth advisor at Bartlett since 1994, so he certainly knows the ropes around here. He's going to kick us off today by taking a look back at what has happened so far during this very interesting year.
Well, our agenda for today, we're going to provide a look at 2020, just a remarkable year that it's been so far. Seems like a decade's worth of drama all in 1 year. How did we get here? And importantly, where do we go from here? Let's take a look at the markets year to date. This is a picture of the stock market. We're showing you 3 benchmarks. In dark blue is the Standard & Poor's 500 index of primarily large, prominent companies. In light blue is the Russell 2000 index of smaller to mid-sized companies, smaller to mid-sized stocks. And in green is the MSCI EAFE index. EAFE, EAFE stands for Europe, Australia, Far East. So it's the primary index of foreign markets. And what you see here is that all of these benchmarks have more or less rhymed year to date. Precipitous declines in February, March. I don't think we'll forget that for a long time. The markets made progress during the first few months of the year, building on great results in 2019. And then, as we all remember, the bottom abruptly dropped out from the high on February 19th to the low on March 23rd, just a little over a month later. The Standard & Poor's 500 index fell 34%. and the indexes of the Russell 2000 of small to mid-sized companies and the overseas index fell even more severe declines. And just as despair seemed so pervasive and was setting in, on March 23rd, the markets began to turn around. We've had a very significant rally. The Standard & Poor's 500 index, notwithstanding some volatility in the last week, is up for the year and is right back to those February highs. The Russell 2000 and the overseas index haven't come up as much, haven't reclaimed those highs, but still very solid comebacks. So, you know, a remarkable year so far, and it conjures up the question that Aliya is going to tackle, which is, you know, where do we go from here? How did we get here? This remarkable environment. We don't need to tell you. You look at the picture of the restaurant on your left, might have looked that way in January, and then on the right, what you're experiencing now. Entertainment on the left, what you're experiencing now. I guess if you're a college student, the stories we're seeing, you're not behaving any better, but certainly a remarkable time. And how did we get here?
So as Jim recapped, this year has been the definition of a roller coaster ride through the markets. So given all of that, we wonder, how could the market continue this upward march? So we believe the biggest reason is that Washington, lawmakers, and the Federal Reserve have been determined to power the country through this crisis. So for the first time in a while, both monetary policy and fiscal policy are actually working together. So this output comes to us via massive stimulus and extremely low interest rates, both of which have kept this country from kind of falling apart. So many experts seem to believe that markets should stabilize once we have a vaccine. So we won't know that for sure until it happens, but the stimulus is really just buying us time until a vaccine is approved and distributed. So as the Feds continue to keep interest rates low, it's challenging to find yields on bonds or cash that are much higher than zero. So if you're reaching for yield, where else can you look besides the stock market? So dividend-paying stocks have acted as a bond substitute in many cases for clients that are still reaching for income. So that's another reason why the market continues to climb. So as we wonder day to day about news surrounding vaccines or infection rates or additional stimulus, the stock market is looking 12 to 18 months past all of that, when things are hopefully back to normal, or at least getting back to normal. So the market is predicting that companies will be much stronger when they can resume regular production, execute key services, and stabilize their earnings. So you might think, I guess all companies are benefiting from the generous stimulus and low rates, but that's not necessarily the case. Really, only the biggest companies have had boosts to their performance, and I'll show you that on the next slide. So the companies that have truly benefited from investors' increased confidence in the markets are those that were already poised to succeed in this environment: technology and communication companies. The top 5 stocks, Apple, Microsoft, Alphabet, which is the parent of Google, Facebook, and Amazon, make up over 20% of the S&P 500. And it's often overlooked how much their results drive the entire market's results. It makes sense though. In this new reality, cloud computing, social media, and snack delivery for that Zoom party you're having later are all services that have grown tremendously. And as shown in the chart, the jaw-dropping performance of the top 5 stocks in the index is masking the fact that the average stock still actually has a negative return in 2020. So markets are really rewarding these premier companies for their growth, as you can see in the difference between the price to earnings ratios. Investors are willing to pay 31 times earnings for the top 5 companies, but only 21 times for the other 495. So on days when these stocks do very well, the market seems to be really soaring. But on days when companies in smaller sectors of the market do well, think utilities or energy, it's harder for them to push the markets higher. In general, US markets are driven by these high growth companies, but it has been even more apparent that that's the case coming out of the lows from the initial shock of the pandemic earlier this year. Still, this is positive news considering many stocks have recovered at least a portion of their losses from March. So Jim will talk to us about some of the other positives that we're seeing in the economy right now.
Well, as the chart showed, those other 495 stocks, while not as stupendous as the top five, have made considerable progress from those March lows, and the market's made considerable progress. And I think the general reaction that we experience from clients, from trustees, from other professionals that we work with is certainly satisfaction and relief, but also considerable skepticism and doubt. Does this make sense? And we think it does. We think it makes sense that the markets have had a strong comeback because we have had a very forceful economic policy response. We anticipated this and hoped for some of this back in our writings that we sent out during the March period, and we've had it. Bartlett gives Jerome Powell a lot of credit. The Federal Reserve was on the case right away and worked to lower interest rates and avert a crisis. The legislative process, we all know, takes longer. The Founding Fathers built it that way. It's more deliberative, it's messier. So it took longer, but fiscal policy, we've now had 4 major stimulus packages highlighted by the CARES Act and aspects like the payroll protection and loans and cash payments to households. We applaud that. Now, right now it appears we're at a stalemate on this 5th stimulus package, but we may get one. We've had 4 so far, and what a powerful 1-2 punch from the Fed and the Congress. And we've seen genuine improvement. As we look at factors on this next picture, we had, for a brief period, what you might almost think of as a brief depression. We hit a 50-year low in unemployment in January of 3.5%. And the pandemic set in February, and all the shutdown measures that we remember. Boy, in 6 weeks' time, we were north of 15% unemployment. It was just an implosion. Now, the latest data, just last Friday, unemployment is moving down toward 8%, and all indications are it's going to go lower. So we've seen genuine improvement there. The leading economic indicators have firmed and are trending up. And corporate profits generally have been pretty good. During the month of July and August, almost all of our companies provided their second quarter earnings reports along with outlooks for the rest of the year. And in the main, we would say the results were good. Under difficult circumstances, good companies persevering well, maintaining profitability, and maybe guarded optimism about the rest of the year. But we'd give corporate America pretty high marks for weathering this. And I think this, when we think about the last 3 months, another thing that it shows is that, and Aliya alluded to this, markets are always forward-looking. If we think back to the memorable financial crisis of 2008, 2009, the stock market bottomed in March of 2009 and began a nice comeback. And yet there wasn't genuine identifiable economic improvement, particularly with unemployment, until February of 2010, a full year later. So if an investor waited for definitive evidence that the skies were clearing and that things were getting better, well, she's left behind. And The same thing has played out this time. The markets have made a strong improvement beginning on March 23rd, well in advance of the economic improvements that we're seeing, manifest only recently. Real significant economic improvement. And where do we go from here? And Aliya is going to walk you through our thinking on what is next.
So what does Bartlett make of all of this? Despite, Jim mentioned that growing strength in the economy and strong stock market performance, volatility is still likely here to stay for some time. So we saw the S&P 500 reach record highs in the past few weeks, only to see performance take a U-turn earlier this week. So no, we don't always have on our rose-colored glasses here at Bartlett. And if we want to move to the next slide, we think the economy is improving, but full recovery will take longer than usual. We also recognize that factors that could generate a gloomier outlook, such as rising infection rates or heightened political tension in this election year. So this reminds us to really turn right back to the concepts that have always been our guiding principles. So over the past 2 years, and we've mentioned this a couple times, but we've been getting more defensive in our investment strategy. So we remain focused on quality businesses with strong cash flows, low levels of debt, and reasonable valuations. And we can go back one slide, that would be perfect. So we're looking at, these are some of the things that we really rely on when we're trying to build portfolios for the long term. So currently, we like companies in healthcare, technology, and communication sectors. And these are companies that have growth and recurring revenue that can weather a downturn. So for example, software as a service, companies that offer software often have a monthly subscription. So that generates more predictable cash flow for that company. So we are still looking at areas of opportunity in more beaten up cyclical sectors like financials and industrials. But as the economy improves, these companies should benefit, but we'll probably have to be a little bit more patient for that. Also, as I mentioned earlier, dividend paying stocks have been a reliable source of income as cash and bond yields remain low. So we do though, there's still some hope for bonds, and we have a team of fixed income experts that are working overtime to find opportunities in both the corporate and municipal bond markets. But we would not recommend turning to very high yielding bonds right now, as the quality of these bonds are likely low, and safety of principal is really important during times like this. Lastly, good preparation is key. We want to be proactive rather than reactive. And these occasional market scares really validate the importance of timeless planning principles. And that includes constructing a thorough investment policy statement, implementing an asset allocation that's tailored to a client's risk tolerance levels, rebalancing at appropriate intervals, and developing a careful plan for cash withdrawals. So by doing all of this, it helps us keep an eye on our long-term goals and makes the rough patches a little bit easier to stomach. So it's beneficial to remember why we want to stick to our plans and stay invested during even the most turbulent markets. So as we all know, market turbulence is normal, it's ongoing, and it's a good reminder that the market isn't always an easy place to be. But we're accustomed to this and we're ready for it because history shows that we get 5% setbacks about three times per year. 10% corrections occur about once a year, and the market plunges 20% or more every 3 to 4 years. Well, we've had the distinct honor of experiencing all three of these unsettling scenarios in 2020. However, if we are diligent and patient, we will likely be rewarded. So over the time period listed in the chart, I think all of us can easily think of a few dramatic market downturns and corrections, including the financial crisis in 2008. Yet, despite everything that happened, the S&P 500 returned 9% annually, and bonds returned over 3% annually. So I really think these figures emphasize the importance of staying invested, seeing that cash only produced about 1% annual return during this time period. So if the market stumble in 2020 wasn't provoked by the pandemic, it would have sooner or later been triggered by something else. So that's why Bartlett very much believes that time in the market is much more impactful than market timing for patient long-term investors. So this persistence will allow us to benefit from swings in the market instead of being a victim of them.
Aliya, I look at this chart and looking back 15 years, you think of all the episodes this includes. So it certainly includes that memorable financial crisis in 2008, 2009. It includes the European crisis in 2011, when there were questions around the sustainability of their currency. Countries were seemingly unraveling. It includes an oil price crash in 2015. It includes China devaluing its currency and the stock market. I never forget, the month of January 2016 was the worst opening month in the history of the Dow Jones Industrial Average. 2018, 2020, all these various episodes. And yet, you know, if you were a patient investor, 9% a year. I couldn't agree with you more. If we did not have a pandemic in 2020, certainly something else would have shaken people up. And one thing that is beginning to prompt some calls and concerns, as we show on the next picture, people are beginning to get concerned about the election. And with a wide client base, we've got people on, I'd say most are in the middle, but people on both sides. And you may hear from a client who's very concerned about a second term, and then you hear from another client who's very concerned if there isn't a second term. And one thing we remind people over and over again is to try and keep any political biases, now that's hard these days, but try to keep any political biases removed from your investment thinking. What powers stocks over long periods of time is the success of companies, the ability of good companies to increase revenues, increase earnings, increase dividends. It's those business results. And the wellspring of that is a growing economy. And with occasional interruptions, recessions now and again, the pattern in this country has been economic growth, and we think it will continue to be. And as this chart shows, the stock market has made progress regardless of presidential party. We had memorably fantastic periods of market performance under Eisenhower in the 1950s, Reagan in the 1980s, and the first Bush shortly thereafter. We also had memorable periods of fantastic stock market performance in the 1960s, Kennedy and Johnson, the 1990s Clinton, and 8 years with President Obama. So, and incidentally, what generally happened in those periods is that Republican administrations had Democratic Congresses, Democratic administrations had Republican Congresses. So it's prompting a lot of questions. Certainly the outcome may impact our thinking about different sectors. What will be the outlook for regulation of the financial sector or the healthcare sector, for instance? We'll have to factor that into our thinking. But in terms of overall investment, we don't have any plans for broad sweeping changes in asset allocation, whether it's a red result in November or a blue result. But we thought we should close with this because it is a question that's coming up more and more. And speaking of questions, I think that concludes our prepared remarks, and we may have a lineup of questions that have come in, and Aliya will take us through those.
We do have one question. When you say that one of your criteria for choosing stocks is reasonable valuations, can you define reasonable valuation?
Well, there isn't any single number. We look at a wide variety of measures, and it varies sector by sector. The way you think of a valuation for a healthcare company is different than the way you think of a valuation for a financial company. But some general benchmarks would be price compared to the earnings the company is producing, price compared to the revenues or cash flow a company is producing. We'll also consider, and more consider the dividend yield and the sustainability and growth of the dividend. Because as Aliya said, we're in this remarkable interest rate environment, and this will likely persist, where courtesy of the Federal Reserve's policies, interest rates are very, very low. If you went out to buy a 10-year Treasury security today, you'd get less than 1%. And so also thinking about dividends, where can you get solid 2 to 3% cash returns by way of dividends? So earnings, cash flows, revenues, dividends, those are all factors we think about in terms of valuation. The general level of valuation is higher today. As Aliya showed you in that earlier chart, the market based on earnings expectations a year ahead is around 21 times earnings. Post-war norm, post-World War II, is about 15 or 16. Now, the fact that interest rates are so low supports a higher level of valuation, but we do think about that as we're looking stock by stock. As best we can, we'd like to buy stocks at or below that level of average valuation. So I hope that helps, but just a wide variety of factors we consider.
Great. We had another question come through. It says, do you see a new industry coming forward because of the pandemic? So I can talk briefly about that. It has led to a lot of changes that we've seen. And I mentioned that the technology stocks have really taken off. So I think that people are finding new ways to do the work that we've traditionally done in person. So if you think about healthcare stocks, you used to visit the doctor's office, and now you can just hop on your computer and have a conversation with your doctor online. So there are a lot of different ways that could play out, but we really think it forces companies to be more efficient, think of better ways to do things, and maybe adjust for the long term, because this environment that we're in right now could last, a little bit longer than what people are thinking it will.
Aliya, just to add to that, I've often thought, what if this pandemic had struck in 1995 or thereabouts, just by way of example? What a tremendous disruption that would have been for a company like Bartlett. And yet, in 2020, by way of policy, we are all fully networked remotely. That's a business continuity measure we've had in place for a long time, never dreaming there would be a pandemic. But by virtue of that, which incidentally is enabled by the cloud computing that's been pioneered by those companies you mentioned, like Microsoft and Alphabet. When we closed the office for a couple of months, we were all able to continue almost seamlessly the next day, logging into all the firm's systems, doing our thing, meeting each other for our investment meetings by way of Zoom calls instead of interacting personally. But it really didn't throw us off at all. So that aspect, as you say, that technology and what that's enabled, that looks to continue to be promising. Another way to think about that question is, are there any businesses that have been permanently changed to the negative? It remains to be seen, but I think just, my experience returning downtown, we're coming back and so forth and so on, but it's very slow. And our building is still running at about a third. You have to wonder about the traditional office setup, law firms, accounting firms, investment firms, et cetera, and commuting and so forth. Can be challenging for real estate.
Yeah, I definitely think that in terms of if that's changing, what about all the restaurants that are downtown? So how do they survive in a period where nobody's downtown, so nobody's going out to lunch? So definitely a lot of different changes that people will have to be creative if they want to make sure that their businesses continue and grow. So we have another question. How will paying for the stimulus packages affect the economic future? Jim, you talked about that a little bit.
Well, back in March, we sent out a message and during the crisis, one of our email commentaries, and I think we made the statement that, we've more or less declared war on coronavirus, and we did. And the combination of the fiscal policy orchestrated by Jerome Powell or the monetary policy orchestrated by Jerome Powell, and then the fiscal policy with the administration and Congress, the combination of those two things relative to the economy was the largest effort. You have to go back to Franklin Roosevelt. So just extraordinary. And what has happened historically, you go back to World War I, you go back to World War II, Korea, Vietnam. When we've come out of periods of wartime, we have to work down the debt that we accumulate. And it doesn't have to be paid right away. It's not as though there's some margin call and it has to be paid right away, but it has to be worked down. And Aliya, I think what we will see and probably should see is that you'll see higher taxes. One of the things that factors into our thinking around municipal bonds, for instance, but you'll see higher taxes and maybe some level of austerity around spending where whether it be defense spending or ways to handle entitlements, those need to be slowed down. But probably higher taxes are in the offing.
We have another question. What percentage increase are you putting into most of your forecasts and simulations for 2021 and beyond?
Well, I think Aliya mentioned earlier financial planning, and particularly for people contemplating retirement and moving into that mode, we do a lot of simulation work. Many of you who have experienced that, the industry term, believe it or not, is called a Monte Carlo simulation. And you build in some baseline scenarios into this, and we're being pretty measured in our expectations. Our baseline scenario long term on a stock return for a market would be 7%. Generally for bonds, I think we're using 2.5%, and Aliya for cash, 1%. And that means for a newly retired person, let's see someone's just concluding their career at Procter & Gamble and they've retained Bartlett, and we're assembling a balanced account with all these various and sundry safeguards. A reasonable baseline expectation for a balanced account would be about a 5 to 5.5% return. So you really need to make careful, realistic assumptions, and that would be our thinking.
Let's see. Well, we talked earlier about the changes in kind of corporate office buildings, but how will the reduction of in-person offices affect the unemployment rate? I know we've talked about this a little bit in that a lot of people who are very lucky were able to seamlessly transition from working in the office to working at home. But what about the industries where you can't work from home? If it's, production and industry and industrials, so how would that affect the unemployment rate?
Well, I think those industries, where it's mission critical that you be on site, you're manufacturing something. you're on an assembly line. Those industries will come back. The industries that may be more significantly impacted and may have a very, very slow, grudging comeback, if at all, I think are some of those service-oriented industries that are sort of embedded in how service businesses like Bartlett have worked over the years. So I think employment in the restaurant industry, employment in retail, employment in travel-related industries, that comeback is going to be much more difficult, much slower. And that's why I don't think, none of us think it's realistic that we're going to get back, regardless of who's elected, promises and so forth, that we'll get back to that 3.5% unemployment rate we had in January, because you will see losses of more permanence in some of those areas that just aren't coming back. Myself, returning downtown, just observing restaurant traffic, you're simply not going to have 10 waiters and waitresses in a restaurant anymore, Aliya, or for that matter, a full cooking staff when you're First Watch or Nicholson's and you've got 6 tables occupied where you used to have 20. So I think that's where where it's going to be a lot slower, those service-related employment.
Agreed. This question is, what effect, if any, does social unrest or protest have on the stock market? So my thinking on that is that it kind of plays out over a longer term, I think. So maybe we don't have the initial shock like we did with COVID-19, but we have companies that will need to adjust their thinking. We've seen over this time frame that ESG stocks, so that's environmental, social, and governance related, socially responsible stocks that have kind of catered to those aspects have actually done really well. So I feel like the social unrest and the protest fall into that category. Or our company is doing what it takes to improve in that regard. And I think as investors recognize that and find importance in that those companies will be the ones that will succeed longer term. But I think that plays out over a pretty long time frame instead of an immediate effect.
I think that's a good point, Aliya. I think, you go back to those, some of our listeners would remember, you and I wouldn't, but those epic Vietnam War protests, college campuses overtaken, and one of the political conventions in 1968 totally unraveling, these different sorts of things. I don't think you'll ever see something like that nationwide, and yet the economy moved along and markets did pretty well. So not a hit right away, but long term it's a concern and how it will play out.
We'll do a couple more questions. Can you talk about the sectors that you see moving up in 2021?
Well, I think you alluded to a few of those, Aliya. The areas, probably the 3 largest sector weightings in our accounts, technology, healthcare, and consumer-related businesses. We see those continuing to do well in 2021. Particularly, they should be somewhat more resilient if we have a setback, if we have some relapse or interruption in this economic comeback we've seen. Those are areas that should do well. Those would be our favorites, but I think, as you alluded to earlier, we're also on the lookout, areas that have been hit harder, like, for instance, the industrial sector. Always on the lookout for opportunities there, as as well as the financial sector, which is struggling right now because interest rates are so low. It's hard to earn money if you're a bank, but looking for opportunities there too. But the sectors you mentioned earlier, technology, healthcare, and the consumer, stand out to us.
Do you see long-term changes in higher education? So closing of colleges, universities, and more online learning companies. How do you turn that into a business? So you alluded to the fact that maybe not a lot of colleges are following the rules that they should right now, with people out, students going to parties and whatnot. So that's leading to some colleges needing to close down and go back to online classes. So do you see any long-term changes in higher education?
Well, I think one very welcome long-term change, any person who's listening who's a parent or grandparent, I think would welcome this, is if we bend the curve on the inflation rate in higher education, because we all know the rate of increase in tuition costs has just far outstripped the rate of inflation in the rest of the economy, including healthcare, where we've seen higher costs over time. And certainly there are reasons for this that we could go into, such as you have had in higher education kind of a debt bubble, a student loan debt bubble, and that's contributed to it. But I think we're starting to see some colleges, in light of this blended model with some degree of remote learning, they're issuing rebates or lowering tuition costs. And I think that's you're looking for silver linings in all this. I think that would be a very, very welcome change if the rate of tuition inflation begins to come down. That would be a very welcome change. And it seems to me that's probably inevitable, that if you're going to these remote or blended models, you're going to have to do that.
Mm-hmm. This will be our last question, but feel free to reach out to us. We've got our contact information. I believe it's on the next slide. If you have additional questions, we'd be happy to answer those for you. But wanting to know, what is your outlook for precious metals, and how does Bartlett generate income with interest rates so low? Is it in commodities? It's not. What are we thinking for ways that we can generate income for clients with interest rates so low?
Well, you alluded to some of them: dividend paying stocks, quality corporate bonds, quality municipal bonds, preferred stocks, which are kind of a hybrid investment where you need to be careful and judicious, but you can get 5 to 6% yields. I'd say all of those are in the toolkit. The primary precious metal that people think about is gold, and we've been studying gold more and more as an alternative. We've never really embraced it because it doesn't provide any income, and it's hard to value it. Doesn't produce earnings or dividends or revenues the way a company does to support its stock or bonds. But historically, it can be a safeguard in times of significant turmoil. And the other thing that helps precious metals is that with interest rates so low, the opportunity cost of owning gold and not earning income isn't as high as it used to be if you're not getting any yield on treasury securities or things like that. So lower interest rates make those more palatable investments. And gold in particular is a possibility, something that we think about and study. It's a possibility as a part of the portfolio that might be an anchor against severe turbulence or a big surprise. That would be the primary precious metal we would consider.
Great. Well, thank you, Jim. And thank you everyone for attending today. We hope we gave you some insights that you can kind of take back and think about. Feel free to visit us on our website, or if you have questions, We actually, if you want more Bartlett knowledge, we're having an ESG event on September 30th. So you can learn more about that event on our website. So thank you very much for attending, and we'll see you soon.
Thanks, everyone.